600,000 families already signed up. The government is handing your baby $1,000, and the IRS is waiting to take back $300,000. That's not a typo. Right now, millions of parents are opening Trump accounts. They're filing Form 4547. They're claiming the free government deposit, and they have no idea what's coming. Not because the account is bad, because the tax rules are completely misunderstood. Here's what's happening. Parents see the headlines, free $1,000 for your baby. They sign up, they feel great, they think they're setting their kid up. But buried inside the IRS guidance, 3 tax traps that could erase most of the gains. And here's what makes this so dangerous. These traps don't hurt you today. They don't hurt you next year. They hurt your child in 18 years when they try to use the money. By then, the damage is baked in. The good news, if you understand these traps now, before you contribute a single dollar, you can avoid every one of them. By the end of this video, you'll know exactly how the Trump account tax trap works, what it could cost your child over their lifetime, and the one move at age 18 that could save them over $300,000. And I'll give you a decision tree you can screenshot. It tells you exactly what to do and when. Quick note, I'm not a financial advisor. This isn't personalized advice. It's what the data shows and what the math says. Always do your own homework before making money moves. Now let's talk about why this matters so much. Here's a number most parents haven't seen yet. Trumpaccounts.gov. Projects that the $1,000 deposit could grow to $243,000 by age 55. Sounds incredible, right? But here's what's hiding behind that number. Those projections use historical S&P 500 returns above 10% a year. They don't adjust for inflation. And the big one, they don't subtract the tax bill. When your kid withdraws that money, the IRS taxes the gains as ordinary income, not capital gains, ordinary income. That's the same rate as wages from a job. So a big chunk of that growth, it goes straight back to the government. That's the part nobody's explaining on the sign-up page. And it's not even the biggest trap. Let's break this down piece by piece. Trap number 1. Trump accounts are not tax-free. This is where almost everyone gets confused. Most parents hear tax-advantaged and assume that means tax-free. Those are two very different things. A Roth IRA is tax-free. You pay taxes on the money going in, then it grows. And when you take it out in retirement, you owe nothing, zero. A Trump account, completely different. Here's how it works. You contribute up to $5,000 a year with after-tax money. That means you already paid income tax on those dollars before they went in. The money gets invested in an S&P 500 index fund. It grows. And while it sits in the account, no taxes. That's the tax-deferred part. So far, so good. But when your child takes the money out after age 18, every single dollar of growth gets taxed as ordinary income. Not the lower capital gains rate, the higher ordinary income rate, the same rate they'd pay on a paycheck. Why does this matter? Let me show you the real numbers. Say you're a parent in 2026. You open a Trump account for your newborn, you get the $1,000 government deposit, and you max out contributions at $5,000 every single year for 18 years. That's roughly $108,000 in total contributions. At 6% annual growth, that's a conservative estimate from Schwab, the account hits around $191,000 by age 18. Now here's the critical piece. Your contributions, yet the $108,000 already got taxed. That's your money. That's your basis. You shouldn't owe tax on that again. But the $83,000 in investment gains, taxable. The $1,000 government deposit, taxable. Any employer contributions that went in pre-tax, taxable. Everything that didn't come from your after-tax pocket gets hit with ordinary income tax on the way out. And that leads directly to trap number 2. Trap number 2, failing to track your basis. This is the mistake that's going to hurt the most families. And it's completely preventable. Here's the scenario. A parent contributes $5,000 a year for 18 years. They don't keep records. They lose the paperwork. They figure the brokerage handles it. Their kid turns 18, sees $191,000 in the account, decides to pull some money out for college. And because nobody tracked the after-tax contributions separately, the IRS could treat the entire withdrawal as taxable income. Let's do the math. At a 22% tax bracket, taxes on $191,000 is $42,000. Taxes on $84,000 is about $18,500. That's a difference of $23,500 gone because of missing paperwork. And this gets worse over time. If the account keeps growing and they keep withdrawing without proper records, the overpayment compounds. Here's the fix. It's boring, but it works. Keep every single contribution receipt from day one. Your financial institution will send a Form 5498 each year. That form shows what went into the account. Save it every year, without exception. Think of it like saving receipts for a home renovation. If you sell the house and can't prove what you spent improving it, the IRS assumes your cost was zero. Same principle here. Start a spreadsheet. Track the date, amount, and source of every contribution. After tax from parents, pre-tax from employer, government deposit. Keep them separate. And don't assume your brokerage will do this for you. They'll report the account value. They'll send the forms. But calculating your basis, that's on you, or your accountant, not the bank. Your future 18-year-old will thank you. Now, trap number 3. This is the big one. This is where the $300,000 comes in. Coming up in about 60 seconds, I'll show you the exact math on how skipping one decision at age 18 could cost your child over $300,000 by retirement. And I'll give you the decision tree that shows exactly what to do. But first, let me explain what happens when your kid turns 18. Trap number 3, the Roth conversion window at 18. This is the trap that costs families the most money, and almost nobody is talking about it. Here's what happens. When your child turns 18, the Trump account automatically converts to a traditional IRA. Automatically. No form to file, no choice to make. It happens. And once it's a traditional IRA, every rule of a traditional IRA applies. Withdrawals are taxed as ordinary income. Take money out before age 59 and a half, 10% penalty on top of the tax. And eventually the IRS forces you to take money out through required minimum distributions starting at age 75. But here's the escape route most families will miss. At 18, your child can convert the traditional IRA into a Roth IRA. They pay taxes on the taxable portion right then, the gains, the government deposit, any pre-tax employer contributions, but they pay at their tax rate as an 18-year-old. And what does an 18-year-old earn? Usually, not much. Maybe a part-time job, maybe nothing at all. An 18-year-old working part-time might earn $15,000 a year. That puts them in the 10 or 12% bracket. If they convert $83,000 in gains at a 12% rate, the total tax bill is roughly $10,000. $10,000, that's the cost of freedom. After the conversion, the entire balance grows tax-free in the Roth. No tax on withdrawals, no tax on gains, no required minimum distributions, ever. Now here's what it costs when families skip this step. And I don't mean maybe costs. I mean guaranteed, unavoidable costs that grow every single year you wait. Let me show you the cost of delay. If your child converts at 18, they pay roughly $10,000 in taxes. Done. Clean slate, tax-free forever. But say they wait until 25. The account has grown. Now the taxable portion is bigger. The conversion tax bill jumps to around $16,000. Wait until 30, about $22,000. Wait until 35 when they're in their peak earning years in a higher tax bracket, over $30,000. See the pattern? The conversion cost doubles roughly every 10 years. The longer they wait, the more expensive freedom gets. And if they never convert, that's when the real damage happens. And if your child doesn't convert and leaves it as a traditional IRA, here's what happens over the next 40 years. That $191,000 sits in the market, keeps growing at roughly 6% a year. By age 40, it's around $700,000. By age 60, it's over $2.2 million. Sounds amazing. $2.2 million. But here's the punchline. Every dollar they pull out of that traditional IRA is taxed as ordinary income. Every single dollar. At a 24% bracket in retirement, the total tax bill across all those withdrawals is over $500,000. Now compare that to the Roth path. Pay $10,000 in taxes at age 18, then never pay taxes on the growth again. Not at age 30 when they buy a house, not at age 50 when they're earning the most, not at 70 when they're enjoying retirement. The difference between those two paths, over $300,000 in lifetime taxes. That's not from some clickbait headline, that's compounding math and the IRS tax code. Now here's the part most parents will skip. Don't skip this. The next section is the decision tree that tells you exactly what to do when your child turns 18. Grab your phone, screenshot this. Let me give you the decision framework. Here's the decision tree. Question 1. When your child turns 18, Are they earning under $47,150 a year? For most 18-year-olds, the answer is yes. If so, convert to Roth immediately. They'll pay 12% or less on the gains. That's the cheapest their tax rate will likely ever be. Question 2. Is your child heading into a high-income career right out of school? Engineering degree, finance job, tech position? If yes, convert now anyway. Their tax rate is going up. Every year they wait, the conversion costs more. Question 3. Did your child somehow land a high-paying job right at 18, earning more than $47,000? Rare but possible. In that case, wait for a gap year, maybe between jobs, maybe during a semester off, maybe during grad school, then convert during that low-income window. Every single path on this decision tree leads to the same destination. Convert to Roth. The only variable is timing. The families who skip this step, they hand their kids a $2.2 million account with a $500,000 tax bill attached. The families who don't skip it, their kids get tax-free growth for life. And coming up in a minute, I'll give you the exact 3-step action plan to protect your child's Trump account from day one, including the one document you need to start keeping this year. But first, 2 more traps you need to know. Bonus trap, the college withdrawal mistake. After age 18, your child can withdraw for education expenses without the 10% penalty. Parents hear penalty-free for college and assume it means tax-free for college. It doesn't. The 10% penalty is waived, the ordinary income tax is not. Let me give you a real example. Your kid withdraws $60,000 for college tuition from the Trump account. They're in the 22% bracket. The tax bill on that withdrawal is over $13,000 for tuition. Now compare that to a 529 plan, that same $60,000 withdrawal for college, completely tax-free, $0 in taxes. Over 4 years of college, that difference adds up to over $50,000. That's a used car. That's a year of rent, gone to taxes. So if college is the goal, a 529 plan is still the better tool. Trump accounts shine for retirement, not education. And here's one more thing most parents miss, the employer contribution trap. Some employers are starting to match the government's $1,000 deposit, and the law allows employers to contribute up to $2,500 per employee per year through a pre-tax cafeteria plan. Sounds great, right? Free money from your boss on top of free money from the government. But here's the wrinkle. Employer contributions go in pre-tax. That means your child owes ordinary income tax on every dollar of those contributions when they withdraw, not just the gains, the contributions themselves. So if your employer kicks in $2,500 a year for 18 years, that's $45,000 in pre-tax contributions. When your kid withdraws that money, they owe tax on all $45,000 plus the growth on top of it. And it's still free money, you should still take it, but you need to know it changes the math on your Roth conversion. The taxable portion at 18 is bigger than you think if employer contributions are in the mix. Add those employer contributions to the gains and the government deposit, and suddenly the Roth conversion tax bill at 18 might be $15,000 instead of $10,000. Still worth it, still way cheaper than waiting. Which brings me to a question I know you're thinking, is a Trump account even worth opening? I've been talking about traps for the last 15 minutes. It might sound like I'm saying don't open one. That's not what I'm saying. Let me be clear. Yes, absolutely open one, but you have to use it correctly. Here's why it's worth it despite the traps. The $1,000 government deposit is genuinely free seed money. No strings, no income requirement, no application to fill out beyond the form. That $1,000 invested in the S&P 500 for 65 years could grow to over $490,000 on its own. Even if you never contribute another dollar, that $1,000 turns into serious money over a lifetime. The tax-deferred growth is powerful over 18 years. No annual taxes on dividends, no capital gains tax on rebalancing. That creates a cleaner growth curve than a taxable brokerage account. And the Roth conversion at 18, that creates a head start on retirement savings that most people can't get any other way. Your kid doesn't need earned income to receive contributions. That's different from a Roth IRA, where the child needs a job. Trump accounts work from birth. No income required, no minimum age. Think about that. An 18-year-old who converts to Roth has a head start of 18 years of compounding growth in a tax-free account. Most people don't open their first retirement account until their late 20s. Your child would already have a decade-long head start. And if you max out contributions and convert to Roth at 18, your child could have a tax-free retirement account worth over $2 million by age 60, all because of a decision you made before they could walk. But only if you avoid these traps. So here's your 3-step action plan. Step 1, open the account and claim the deposit. File Form 4547 with your 2025 tax return. If your child was born between January 1st, 2025 and December 31st, 2028, they qualify for the $1,000 government deposit. Accounts open July 5th, 2026. File the form now so you're ready. And if your child is older, they can still open a Trump account. They won't get the $1,000 deposit, but they still get the tax-deferred growth and the Roth conversion opportunity at 18. Step 2. Track every single contribution from day 1. This is the boring step that saves you $23,000. Create a folder, digital or physical. Save every form, $54.98, your custodian sends each year. Start a simple spreadsheet with 4 columns: date, amount, source, and tax status. After-tax contributions from parents, that's basis. Don't owe tax on it later. Pre-tax contributions from an employer, taxable later. Government deposit, taxable later. Keep them separate. 18 years of record keeping, about 18 minutes of work per year. That's the cost of not paying $23,000 in unnecessary taxes. Step 3, mark the calendar for age 18. When your child turns 18, sit down with them. Show them this decision tree, run the actual numbers based on their real income that year, and have the Roth conversion conversation. If they convert while they're in a low tax bracket, the $10,000 tax bill today saves them $300,000 or more over their lifetime. This one conversation at 18 could be the single most valuable financial decision you ever make for your child. And here's a bonus tip. When you have that conversation, frame it this way. Tell your kid, you can pay $10,000 in taxes right now and never owe the IRS another dime on this money for the rest of your life. Or you can skip it and owe them $300,000 later. When you put it like that, the decision makes itself. Now let me address one more thing before we wrap up. Some parents are wondering, should I do a Trump account instead of a 529 plan? The answer is both, not either or. Use the 529 for education. Tax-free withdrawals for tuition are unbeatable. Use the Trump account for retirement. The Roth conversion at 18 gives your child a 40-year head start on tax-free growth. They solve different problems. Treat them like 2 tools in the same toolbox. Let me bring it all home. Trump accounts aren't a scam. They're a genuine opportunity. $1,000 in free government money, tax-deferred growth in the S&P 500, a potential $2.2 million nest egg by retirement. But the opportunity comes with fine print, and the fine print has teeth. And the IRS doesn't send you a warning label. They don't tell you on the sign-up page that withdrawals are taxed as ordinary income. They don't remind you to track your basis. They don't tell you that pulling money out for college still triggers a tax bill. And they definitely don't send a calendar alert at 18 saying, convert to Roth now before it costs you $300,000. 3 steps: open, track, convert. You have to know the rules to use them. Now you do. That's the move. Money made simple. If this was useful, you'll want to see who can actually afford a $550,000 house after 6.37% rates. The numbers are shocking. I'll link it right here.